Welcome back to the Deep Dive, where we cut through the noise to get right to the knowledge you need. Today, we're taking a deep dive into INPOST SA. They trade on Euronext Amsterdam, ticker INPST. And, this isn't just another logistics company. It's a Polish-born innovator that's really been fundamentally changing how parcels move across Europe.
Exactly. And our mission today really is to explore whether InPost has truly built the last-mile logistics network of the future. And maybe more critically, if its current market valuation is, let's say, failing to recognize its true worth, especially for long-term, value-oriented investors.
Right.
And just for context, we're anchoring all our data to September 10th, 2025. The share price we're using is 11.10 from the close on September 9th.
Okay, 11 euros. And here's the interesting puzzle we're going to unpack for you today. You're about to hear about a company showing incredible growth, a business model with a really powerful competitive edge, almost unassailable, you might say. Yet the market seems to be telling a completely different story with its valuation. It's quite a disconnect.
It is.
So we'll explore that disconnect and what it might mean for you as an investor. First, we'll lay the groundwork look at InPost's core business, its management, the financials. Then we'll dive into market sentiment, ownership, the risks involved. And finally, bring it all together in a conclusion.
Sounds like a plan.
All right, let's jump in with Chapter 1, Business Analysis. So the core of InPost operations, it's this huge network of automated parcel machines, APM.
Right, the lockers.
Exactly, the lockers. They become such a familiar sight across Europe. They let couriers drop off tons of packages at once, and consumers can collect them securely 24/7.
Super convenient.
Totally. Now, revenue mostly comes from fees, right? Paid by e-commerce merchants for these deliveries, plus some from consumer-to-consumer shipping and returns. But what's interesting is that this APM segment, it boasts the highest profit margins. Why is that? Why are the lockers so lucrative?
Well, it really boils down to efficiency, pure efficiency. APM slash the cost per stop for couriers dramatically. Instead of driving around to dozens of individual homes, a courier hits one locker bank, drops off maybe 30, 40, 50 parcels. That boosts their productivity massively.
Right. Makes sense.
And what's also quite clever is how InPost complements this APM network. They haven't abandoned traditional to-door services, so they offer the whole suite.
Ah, okay.
And they've really pushed into Western Europe, especially through acquiring Mondial Relay back in 2021.
That was a big move.
Huge. Mondial Relay adds this really dense network of pickup drop-off points, PDO points, in local shops. And these integrate pretty seamlessly with the APMs in big markets like France, Spain, Belgium, the Netherlands, Portugal.
So it's lockers and local shops.
Exactly.
Yeah.
Plus, their international other segment is actively targeting growth in places like the UK and Italy now.
So it's not just like a random collection of services. It sounds like a flywheel effect,
That's a perfect way to put it.
A denser APM network offers more convenience, so it draws in more consumers.
Yeah.
Then those consumers attract more merchants who want to use the service. That boosts parcel volume.
Which makes the routes cheaper.
Right. Makes courier routes more efficient, lowers costs, and they can pass that saving on, which just speeds up adoption even more. It's a self-reinforcing cycle.
It really is. It builds a strong moat, makes it very difficult for competitors to catch up once it gets going.
Okay, diving a bit deeper into what they actually offer. For consumers, the big thing seems to be the InPost mobile app.
Oh, absolutely critical.
People say it's a game changer. Real-time tracking, instant notifications. You can even open the locker remotely without touching the screen.
Yep, remote opening, plus label sending, quick returns. It's very slick.
And for businesses.
Well, seamless integration with e-commerce platforms is key. And in some places, they even offer full fulfillment and warehousing services.
Wow. Okay, so end-to-end in some cases.
Getting there. And if you look at the scale they've reached, it's just formidable. End of 2024, they had nearly 47,000 APMs.
47,000.
Yep, 46,955 APMs.
Yeah.
And over 34,000 PDO points across 9 countries. And that APM number grew 32% just in that year.
That's huge growth.
It is. And they're number 1 in APM network size in Poland, France, and the UK. And get this, they're the 3rd largest B2C e-commerce logistics carrier by total parcel volume in Europe. Handled a record 1.1 billion parcels in 2024.
1.1 billion. Okay, so their main value proposition, it seems like a trifecta, really. You've got convenience, 24/7 access, no more missed deliveries sitting at home.
Always a pain.
Then cost. You said it's 20–30% cheaper for merchants.
That's
Because of that 10x courier productivity.
exactly. Huge cost saving.
And finally, sustainability. This is big now. Up to 2/3 less CO2 in cities, 90% less in rural areas, just by consolidating deliveries.
Yeah, that's a massive environmental benefit, and it's becoming increasingly important for consumers and businesses alike.
Definitely. So what's driving all this demand in the wider market?
Well, you're looking at massive secular trends. The whole e-commerce logistics sector is just exploding. Forecasts are talking over $1.5 trillion globally by 2030,
Right.
growing at like 14 to 22% compounded annually. INPOST is perfectly positioned. They tap right into the growing demand for sustainable logistics, the boom in cross-border e-commerce, and the big push for automation and digitalization in the industry.
But it's got to be a crowded space, right?
Oh, yeah.
You've got the giants, DHL, DPD, FedEx, the National Postal Services.
Absolutely.
And there are other locker networks too, aren't there? DHL has PackStation, DPD has thousands of stations, Amazon's got its own lockers.
True, they're not alone.
Yeah.
But INPOST isn't just competing, they're arguably changing the game, offering something that's often better and cheaper than traditional home delivery because of that structural cost advantage from the APMs.
Right. And what about regulations? Anything to watch there?
Yeah, the regulatory landscape is definitely evolving.
Right.
The EU's Corporate Sustainability Due Diligence Directive, the CSDDD, that could actually be a tailwind for INPOST. Well, it increases compliance stuff, sure,
Yeah.
but INPOST model is inherently more sustainable, lower emissions, efficient. So they're kind of ahead of the curve compared to traditional carriers. It aligns well with what the directive wants.
Okay.
Then there's the EFTI regulation coming by 2027 that should help their tech-heavy model with digital documents. But on the other hand, you are seeing some cities like Stockholm bringing in rules about where you can actually place lockers.
Mm-hmm.
So getting those prime spots might get trickier.
Urban space becoming a premium. That
Yeah.
brings us to a really key point, barriers to entry. It sounds simple, put up some lockers, but I bet it's harder than it looks. What really stops others from just copying them?
It's way harder than it looks. First, the capital investment is huge. Thousands of euros for each APM. You need tens of thousands of them.
Okay, big bucks.
Then, prime locations are scarce. INPOST moved fast. They often locked up the best spots near supermarkets, train stations, apartment blocks with exclusive long-term contracts. That first mover advantage is hard to overcome.
Right, they got there first.
And finally, the technology. It's not just loggers. It's the app, the back-end software, the complex algorithms for routing couriers efficiently. It's a sophisticated tech operation.
Okay, so significant hurdles. What about their specific competitive advantages then? What really sets them apart?
Well, first, their brand is incredibly strong, especially in Poland. 99% recognition, net promoter score of 77. That kind of customer loyalty is gold.
NPS of 77 is amazing.
It really is. Then, those cost advantages and economies of scale we talked about, the APM model gives them huge operational leverage. One courier, hundreds of parcels, one stop. That's structural cost advantage. You see it clearly in Poland, where the mature business runs at a stunning adjusted EBITDA margin of 46–48%.
46 to 48% margin. Wow.
Yeah. It shows the potential.
And they've got those powerful two-sided network effects, right?
Exactly. More lockers attract more users attract more merchants make the network better for users. It reinforces itself constantly, strengthening their moat.
Okay. Anything else? Unique assets.
Definitely. That INPOST mobile app is a core differentiator. Over 13.7 million users just in Poland. And they keep adding things like INPOST Pay. Plus, they have their own R&D facility. They design innovative APMs, L-shaped ones to fit awkward spaces, refrigerated ones.
Refrigerated for groceries.
Potentially, yeah. And they develop their own software, like dynamic courier routing. Combine all that with getting those prime real estate contracts early,
Yeah.
it adds up to a really significant, durable competitive edge.
Okay, that paints a really clear picture of the business. Now, let's shift focus to the people running the show. Chapter 2. Management evaluation. It's a founder-led company, which many long-term investors really like.
Often a good sign.
Rafa Brzoska, the founder, he seems to have this clear vision, an aggressive land-grabbing strategy, as it's called. He took it from a local distributor to this multi-billion-euro European leader.
He certainly did. And the team around him is very seasoned, too. You've got Javier Van Engelen as CFO, bringing loads of financial experience. Michael Rouse as CEO International was absolutely pivotal in integrating Mondial Relay and driving that growth.
Right, the Mondial integration was key.
Crucial.
Hmm.
Their track records, solid, successful IPO in 2021, those transformative acquisitions like Mondial Relay for scale, and more recently, Menzies in the UK. Taking full control of logistics, there was a big strategic move.
How are they on communication and transparency?
Pretty good, actually. They provide comprehensive investor relations materials, hold regular earnings calls, have detailed corporate governance policies online, and Brzozowska himself is quite a well-known figure in Poland, not just for business but also philanthropy. Adds a layer of trust.
And their capital allocation, where's the money going?
It clearly shows their priorities. Heavy reinvestment in organic growth. Nearly PLN 1.4 billion in capex in 2024 alone.
Wow.
And get this, 63% of that capex went straight into international expansion. They're not sitting still.
Clearly betting on growth outside Poland.
Definitely. And their M&A has been very strategic, not just buying stuff randomly. Mondial Relay was the beachhead quick-scale market entry in France, Benelux, Menzies in the UK. That was vertical integration. Control the whole chain end-to-end so they can replicate the Polish model in Europe's biggest e-commerce market.
Makes sense. What about shareholder returns, though? Any dividends? Buybacks?
Well, typical for a high-growth company, really. Share buybacks are modest, mostly just for employee incentive plans, and no dividend. Their official policy is growth first.
So, for a value investor, how should we think about that? Is it just burning cash, or is it smart reinvestment?
I'd lean towards smart reinvestment. This isn't growth for growth's sake. They're putting capital into assets, those APMs, that generate really exceptional returns, especially once a network matures. Remember that Polish ROIC?
Ah, yeah, the 50% number.
Exactly. So the return for shareholders here isn't about income right now. It's about capital appreciation as those international markets mature and hopefully reach similar levels of density and profitability.
Okay, that clarifies things. And speaking of returns, how effectively are they deploying that capital overall? What's the group return on invested capital look like?
Group-wide, the ROIC is strong. It's ranged between about 11.3% and 16.4%. Which is respectable, especially given the heavy investment phase.
Okay.
But the key, again, is Poland. That mature segment showing a pre-tax ROIC around 50%. That number isn't just a metric. It's like INPOST's proof of concept for international expansion. It shows the massive profit potential if they can replicate that density in France, the UK, Italy. Every new APM there is potentially future cash cow.
Got it. Okay, let's get into the numbers properly now with Chapter 3, financial analysis. First off, market cap is roughly $5.6 billion as of September 10th, 2025.
Correct. And revenue growth. It's been genuinely explosive over the last 5 years.
Like how explosive?
Well, from PLN 2.5 billion in 2020 up to PLN 10.9 billion in 2024.
Whoa.
Yeah. Growth rates were like 104% in 2020. And even in 2024, still a very impressive 23.5%. So, okay, it's moderating from hypergrowth, but sustaining over 20% growth on that much larger base. That's seriously impressive. Shows real ongoing momentum.
And profit margins, are they holding up with that growth?
They are robust. Gross margin is exceptionally high, nearly 76%. Operating margins are between, say, 15.3% and 18.1%. Net profit margins, 7.9% to 11.4%.
Pretty healthy.
Very. But it's crucial to remember these are consolidated figures. They blend the super high-margin Polish business with the currently lower-margin international segments that are still investment mode.
Right, the mix matters. What about cash flow? Are they actually generating cash with all this spending?
Yes, and this is really impressive. Despite those huge investments in building out the network, INPOST generated about PLN 1.44 billion. That's roughly 404 million in free cash flow over the last 12 months.
Okay, so cash positive after investments.
And growing. That free cash flow was up 22.3% year over year. It really shows a high-quality business that can fund significant growth itself and still have cash left over.
And earnings consistency. Is profit growth steady?
Very strong. Net profit grew at a compound annual rate, a CAGR, of over 37% from 2020 to 2024. That consistent upward trend really speaks volumes about their execution capabilities.
Okay, but what about debt? That level of expansion must require borrowing.
It does, and this is a point bears often raise. Their debt-to-equity ratio looks high at 3.21 or 321%. Total debt is around 2.19 billion.
That does sound high.
It does look high on the surface, but a more useful metric here might be net debt to adjusted EBITDA. That's a much more manageable 1.9x. And importantly, it's been steadily declining. It was 3.2x at the end of 2022.
Ah, so profits are growing faster than debt.
Exactly. Their growing cash flows are comfortably covering their obligations. Now, their current ratio is tight, 0.61. Usually that's a warning sign about short-term liquidity.
Right, less than one.
But for a business like INPOST, with super fast cash collection from merchants and consumers and all that strategic reinvestment in long-term, high-return assets, that tightness might actually signal hyper-efficient capital use, not financial strain. And as we said, no dividends. All cash goes back into growth.
Okay, that context helps. Let's talk valuation then. What are the multiples looking like?
Their trailing PE is in the range of 20.4x to 24.7x. But the forward PE, based on analyst estimates, is significantly lower, around 13.3x.
Okay, so the market expects strong earnings growth. How does that 13.3x compare to others?
It compares quite well, actually. DHL, the logistics giant, trades around 13-15x forward PE. Allegro, their big e-commerce partner in Poland, trades much higher, like 35x. So that forward PE suggests INPOST is being valued more like a mature, slower growth logistics company, despite its obvious growth trajectory.
Interesting. What about intrinsic value estimates, like DCF models?
Yeah, if you look at discounted cash flow models, for instance, one from Simply Walstein puts INPOST's fair value estimate at 25.1 N per share.
25.18 compared to the current 11.10.
Exactly. A huge potential upside. Other analyst DCFs range roughly from 18.78 to 22.69 per share. Now, these models make assumptions, of course, typically a conservative 1.5% perpetual growth rate after an initial high growth period, and maybe a 6.2% discount rate. But even with conservative inputs, they consistently point to significant potential upside from the current share price.
Okay, that's a stark difference. Let's shift gears then and look at Chapter 4, Market Sentiment. What are the analysts saying?
Well, the analyst community is overwhelmingly bullish. It's got a strong buy consensus from 16 analysts covering the stock.
Strong buy, and their price targets.
The average 12-month price target is 18.83, which implies an upside of over 69% from the current 11.9 price. So analysts definitely see value here.
Wow, 69% upside consensus. What about recent news flow? Mostly positive.
Largely positive, yes. Lots of headlines about record parcel volumes, successful integration of acquisitions like Yodel in the UK, Sending in Spain, reinforcing that international growth story. However, there is an important nuance. INPOST themselves have mentioned a visible softening of e-commerce volumes in their very mature Polish market. So that adds a little note of caution, even while international growth looks strong.
A slowdown in Poland.
Okay.
What about market indicators, like short interest or moving averages?
Specific short interest data isn't always easy to get for European stocks, but we know there are about 2.5 million shares available to borrow for shorting, which isn't insignificant. More telling, perhaps, is the price action itself. The stock is trading below both its 50-day and 200-day moving averages.
Below both.
Yep, for example, the 50-day might be around 12.75 and the 200-day around 14.68, while the stock's at 11.10. That suggests consistent downward pressure, or at least a lack of strong buying momentum recently.
So there it is again, that disconnect.
Exactly. It's fascinating. You've got strong business fundamentals, massive growth, really bullish analysts, but negative price momentum shown by the moving averages. It's a classic value investor's dilemma, isn't it? Often, these situations are where opportunities hide if you believe the market's pessimism is overdone.
Definitely something to think about. Okay, let's look inside the company now. Chapter 5, Ownership Structure. Who actually owns INPOST?
Well, the ownership is quite concentrated. About 32% is held by institutional investors. But the key thing is the top 4 shareholders control over 53% of the company.
Over half. Who are they?
You've got PPF Group, A&R Investments, that's the founder Rafał Brzozowska's vehicle Advent International, and Singapore's Sovereign Wealth Fund, GIC. Big, sophisticated players.
And what does that insider ownership tell us? Brzozowska's stake.
It tells us quite a lot. Brzozowska holds a significant 12.5% stake through A&R Investments. But even more importantly, public filings show his firm has been consistently buying more shares on the open market.
Buying more?
Yes. Like a purchase of 187,218 shares in one go back in November 2023. That kind of skin in the game, especially open market buying, is a powerful signal. It shows his strong belief that the shares are undervalued right now.
He's putting his money where his mouth is.
Precisely. And that high concentration among long-term sophisticated investors like PPF, Advent, and GIC probably means the company's long-term strategy is stable. They're less likely to be swayed by short-term market noise.
What about retail investors?
They hold about 20%, which is substantial. But compared to that concentrated block of major shareholders, their direct influence is fairly limited.
Okay, interesting structure. Now let's turn to the potential downsides. Chapter 6, Risk Assessment. Maybe start with a quick SWOT analysis. Strengths, weaknesses, opportunities, threats.
Their strengths. We've covered these dominant position in key markets like Poland, France, UK, superior cost structure via APMs, strong brand, powerful network effects, proprietary tech. Weaknesses. Well, geographic concentration is still mainly Europe. The leverage is high, that debt to equity over 3.0. Yeah. They depend quite a bit on major e-commerce partners. And rapid expansion means high operational costs right now. Plus, automated systems can sometimes lead to customer service challenges.
Opportunities?
Opportunities. Huge runway still. Structural growth in e-commerce isn't slowing down. Lots of room for more international expansion. Growing demand for sustainable logistics plays right into their hands, and potential for new services, refrigerated lockers, more fulfillment options.
And the threats.
Threats. Intense competition is the big one from incumbents like DHL, DPD, but also other locker networks. Regulatory risks, we mentioned EU rules, city restrictions, and economic downturn hitting e-commerce volumes is always a risk. And you never know, technological disruption could change the game somehow.
Okay, that's a good overview. What about specific macroeconomic threats? Inflation, interest rates?
Yeah, inflation definitely hits them. Fuel for vans, electricity for the lockers, wages for staff, rising costs could compress margins if they can't pass it all on.
And interest rates.
With that debt.
Exactly. As a company with over $2 billion in debt, rising interest rates directly increase their debt servicing costs. That could potentially force them to slow down their aggressive expansion plans if borrowing becomes too expensive.
Right. Any specific geopolitical risks, like trade wars?
Well, something like hypothetical U.S.-imposed tariffs in 2025, probably minimal direct impact, since INPOST operates almost entirely within Europe.
Okay.
But you could see indirect effects. If a trade war caused a broader economic slowdown or maybe reduced demand for European e-commerce exports that use their network, that could certainly impact their parcel volumes. Less spending means fewer parcels.
Got it. Okay, we've covered a lot of ground. Let's bring it all together in Chapter 7. Conclusion. Time to synthesize these findings and revisit that puzzle. Let's start with the bull case for INPOST. Why invest?
Okay, the core bullish points are pretty clear, I think. One, it's a dominant business with a wide economic moat. That moat is built on a structural cost advantage from the APMs, those powerful network effects, and a very strong brand.
Okay, strong note. 2, huge runway for growth. They proved the model works incredibly well in Poland, and now they're exporting that playbook to much larger European markets like France and the UK, which are still far less penetrated by APMs.
Proven model, big markets.
3, management. It's founder-led, they have a proven track record of execution and smart acquisitions, and they're highly aligned with shareholders through that significant insider ownership and buying.
Management aligned.
And 4, valuation. It looks attractive, a reasonable forward PE, and a significant discount to what most intrinsic value estimates suggest. The market seems to be overlooking the strengths or overstating the risks.
Okay, that's a compelling bull case, but we have to be balanced. What's the bear case? Why might someone be hesitant?
Right, the bear case. Number 1 is execution risk, particularly internationally. Replicating that Polish success in diverse, competitive markets like France, the UK, Italy. It's not guaranteed. Each market has its own dynamics.
Execution risk. Makes sense.
2, financial leverage. That $2 billion plus in debt makes them vulnerable. If interest rates spike higher, or if a recession hits e-commerce volumes hard, that debt burden becomes a bigger risk.
Leverage risk.
3, potential margin compression. As those currently lower margin international segments become a bigger part of the overall business, the consolidated group margin might come down from those Polish highs, at least for a while.
Margin pressure.
And 4, competition. It's intense and getting more so. They